like Anders Hall, our CIO, and Roy Yum, our head of privates. I think they both have a vision for how they want to build team and culture. And it really is top down and bottoms up. They themselves as leaders to be driving culture, but also want the analysts at the bottom to also be bringing their perspectives and diversity of thought to the table as soon as they enter into our organization. And I think that's really critical.
Welcome to Advancing VC. At Context Ventures, our podcast, Advancing VC, covers all things startup and venture capital, primarily how startups and venture capital are changing from the emerging manager perspective. We'll be talking with venture capitalists, limited partners, and founders who are actively working at the frontiers of our industry and are advancing venture capital and startups. Today, we are lucky to have two guests, Grace Brown and Ethan Sun of Vanderbilt University Office of Investments. Vanderbilt Office of Investments protects and grows the future of research, discovery, and innovation, ensuring Vanderbilt never stops changing the world. Thank you, Ethan and Grace, for joining us. The first question I have for both of you is, how does someone become an LP? What was your path into becoming a limited partner?
Well, Tim, first off, thanks so much for having us on the podcast. We're super excited to be here. This is actually Ethan and my first podcast ever recorded, and super excited to be chatting today. My path was pretty untraditional, I'd say. I fell into this role and I'm super grateful I ended up here. I guess starting from the beginning, grew up in the Bay Area, was an athlete most of my life. Track athlete, soccer player, ultimately got injured going into my junior year of high school, pivoted really quickly and started rowing my senior year, and ultimately got recruited to go and row at the University of Virginia. There, I was a student athlete for 2 years before having a career-ending back injury, and ultimately needed to find something to channel my competitive energy into a bit more. From there, I felt like startups was a really great ecosystem for me to kind of see the landscape from the trenches, from the bottom layer. So I started working at a health technology startup that had spun out of the Darden Business School, out of their iLab, similar to Harvard's iLab. It was two founders, two offices, one in Charlottesville, Virginia, one in Southern California. I was obviously at the one based in Charlottesville. And there I was really able to scale across a variety of different aspects of the business, first starting off on kind of customer service and business development, and then helping on the more technical aspects of sales and marketing. So learned a whole bunch there, but ultimately felt like I was super siloed into that specific problem set. Wanted to get a broader array of experience and started interning at a venture firm based in the Bay Area, San Francisco, called F7 Ventures. They were at the time founding their first venture vehicle after spinning out of Facebook. And so while there, I got to see them build out their marketing materials, their pitches, going from being potentially generalist to having more of a thematic view of the world, and learned a whole bunch from Kelly and Joanna. Shout out to both of them. They were kind of my intro into the world of venture. But looking at all these materials and doing the research on the back end, I had absolutely no idea what an LP was. Didn't know what a fundraise process looked like. Felt like I had a whole bunch to learn. And ultimately started digging into what the LP space was. What do allocators do? How do they think about portfolio allocation and strategy? And when I was thinking about where I wanted to end up post-graduation, I wanted it to be, one, mission-driven. I think obviously you can learn a whole bunch at a family office, but I wanted to be growing wealth and a legacy for a university and an institution where it goes back to scholarships and campus development and research. And so I felt like the particular type of LP that was most compelling was the E&F space for me. And then started digging into strategies from there of how different endowments think through their own portfolio construction and different asset classes. For me, I felt like the private side made more sense just because I did have the historical context of working at a startup and then slightly touching the world of venture, specifically early stage venture. And so wanted to still be able to have the experience of working in those ecosystems, but then also learning more broadly across private asset classes. And at Vanderbilt, which I'm sure we'll cover a little bit later in the conversation, we are obviously heavily skewed towards venture on the private side, but also invest across buyouts and natural resources and real estate, as well as co-invests. So get to cover all of those spaces broadly while still really focusing on venture. Ultimately, started recruiting for the role my senior year of college, fell in love with the team really quickly throughout the interview process, fell in love with our emerging manager slant, and then Nashville was kind of the ultimate sell for me. Didn't want to be in a massive city, wanted to be somewhere where there was a balance between the rural and the urban. I could drive and be on a river or be in the countryside. And obviously there's a ton of development happening in Nashville as well right now. So it was a culmination of different factors, but that was kind of my twisty and turny story into ending up at Vanderbilt.
Fantastic. Tim, thanks again for inviting us. I'll keep it short because my background is not as interesting as Grace. I grew up in Beijing. Growing up, I wanted to be a pilot. And my dad immigrated to the US when I was 16 years old. I got my first solo flight when I was 16. I really wanted to be an airline transport pilot. Got my license when I was a sophomore. And then there's one conversation that I had with a friend of mine who's 15 years older than me and working in the aviation industry. And he was asking me, Ethan, you don't want it to be at a job where you're going to be replaced by a machine when you are at 45 years old. So when you are in your 40s or 50s, that's the golden age of your career. You want it to be in a sector where you can make difference and where you can actually help it to grow with a lot of new innovation. So after I got my pilot license, I actually took a step back and exploring all the different opportunities. The journey into the LP world is completely out of a combination of serendipity. I got a friend who was interning at the endowment 2 years before I did and recommended me to read this book written by David Swinson. Obviously, that's the Bible of our industry, Pioneering Portfolio Management. And I read it, and obviously I was the only one amongst all the interviewees who read that book. So I got the job, and the summer completely blew my mind in the sense that I was able to meet and talk and ask questions to people that has so much higher caliber and so much more experience than I am. It's just crazy for a college student to think about sitting across the table with people like Howard Marks. So I decided to return to the Office of Investments at Vanderbilt after I graduated. Of course, fortunately, I got a return offer and stay on as an analyst for 2.5 years. First, covering the public side, mainly hedge fund and long-only equity funds. And I think for me, it is really keeping my learning curve steep. Regardless if it's different asset classes or if different stocks that I was talking with our managers, trying to get their insight, trying to get their views. And fortunately, I also got opportunity to work with one of our portfolio managers on the public side, long-only equity funds based out of London for a summer. But after the summer, one thing that I actually realized is I enjoy picking managers, I enjoy picking stocks. And before that, I haven't even spent too much time on the VC side. But I think that what I enjoy the most are the people that I'm working with. And I think that is a very difficult part to get right. I think I know a lot of peers working for consulting firms and working for investment banks who work for 80 hours a day, but absolutely hate their job. And I was just so fortunate to be in a place where when I wake up every day, I actually wanted to go to work and wanted to see my colleague. Grace shared part of the story, but when I first joined, the endowment was only $6.5 billion. But in 2021, we had a really great year. The endowment returned 57% just that one fiscal year. Obviously, that's the work of many years of accumulation, especially contributed by the venture space. We've been investor with Sequoia for 45 years. When I first invested was 1979, when it was still a very small Silicon Valley firm that a lot of institutional investors didn't even discover. So fortunately or unfortunately, a few of our colleagues got promoted, got poached by other places, and happily now contributing to the well-being of the students and the scholarship of other endowments and foundations. And Grace and I got the opportunity to be promoted within the endowment. And since then, really try to spend 80% of our time on building this emerging VC book at Vanderbilt. That's where we spend most of our time, and that's where I believe most of our audience will see us.
Fascinating. There's so many things I want to build on what you all said. First is Grace's background from startups to venture, then LP. I think that gives a very unique perspective, given most LPs that I interact with don't have venture experience or startup experience. The other thing is ENF, I believe, stands for Education and Foundations. Is that a good read?
Endowment and Foundation.
Endowment and Foundations.
Yes.
Okay. And then the other thing that you said, Grace, is heavily skewed VC. And so for a lot of VCs who go to events or try to meet limited partners, oftentimes we'll meet LPs and they say, oh, we do buyout and credit and that's it. Or we do buyout and real estate. And it's fascinating that you said heavily skewed VC. And I picked up from what Ethan said that in 2021, a lot of the growth in endowment was due to potentially some smart investments you all did in VC firms a while ago. And in venture, especially in pre-seed, I oftentimes tell people success is a lagging indicator. You got to put in a ton of work, and then eventually you're going to see the results. And clearly you all have seen those results. And it feels like maybe a fair bit of the reason you all continue to heavily invest in venture is you're trying to find the next Sequoia or Sequoias. Is that a good read or not? Grace, you first.
Yeah, great question. I think, well, first off, I'll cover a little bit of how we think about our portfolio across privates and publics, because that ultimately skews how we build our private portfolio. On the public side, we're focused on emerging markets, small caps. As a result, on the private side, we're very much focused on US, North America, and tech, and growth. And so ultimately, our private book is the way for us to manifest the highest returning potential opportunities possible, whereas the public book is more of the liquidity management tool. And a lot of the structures we're investing in on the public side are SMAs. And so our liquidity profile as an endowment is pretty strong. We can liquidate up to 30% of our endowment in 30 days. I believe that's the correct stat, Ethan, correct me if I'm wrong. And as a result of that, VC ends up being, especially early stage, the best place to put capital in terms of cash on cash returns, at least from what we've seen historically. And to your question about sort of buyouts and private credit, like a lot of other endowments and foundations will invest in, typically we see the 5 to 10x net potential in pre-seed seed. We're less focused on the 10 to 15 years that it'll take to acquire that and the DPI, but ultimately that 5 to 10x net, and then use our buyout book as a way to manage those distributions. So we can start seeing distributions in the buyout funds we invest in 2 to 3 years into a fund life, versus in venture it might be 7, 8, etc. And so that's how we kind of balance it.
Yeah, to me, I think, obviously making an endowment is very complex, but there are two very important factors amongst many, and those are liquidities and return. And obviously, it's always a balance between those two factors as we think through how we're constructing the whole portfolio. What Grace did mention is on our public side, we're having an incredibly liquid book. We almost only invest with our manager on an SMA basis, so separately managed account, where we have tremendous beneficial liquidity terms, which enables us to allocate to the private side, to allocate to the longer duration asset classes without impacting the liquidity. Our boss, Travis Shore, always said liquidity is the biggest risk that any investor have to face. Because if you look at the history of a lot of those risk investors, including people like funds like Citadel, is really because they have liquidity at a time when no one else had liquidity, and they were able to pick up a lot of debt buddy on their way. So I think that's something that we think very hard, and we wanted to put as important part of the portfolio construction. And I think the other part, as I mentioned, is return, which is super important to how we're thinking. On what Tim, you mentioned Sequoia. I think Sequoia has been the single most biggest contributor for us in terms of dollar value generated. But fast forward to today, I think we have to stay true to the return potential that we think across the spectrum, across different asset classes. Obviously, the public side have their own benchmark, but on the private side, how we're thinking about it is we're not investing in venture for the reason for the reason that venture is sexy and venture is exciting and we have to get exposure to venture. That's not it. Ultimately, it's a return-driven question. So on the buyout side, I think within lower middle market buyouts, if you have a good ability to select the right managers, you can actually generate a 2 to 3x net return on a steady state basis without taking the venture risk, with much higher R that you can generate it all out of the portfolio. So on the venture side, if we're getting a 2 to 3x net, that's not good enough. And that really led us to think very hard of where we wanted to expose ourselves. And the answer that we arrived, which will be proven with time, is emerging manager at pre-seed and seed, where the goal is to be able to invest in funds that have potential to generate north of 5x net, north of 10x net return. Obviously, not all of them are going to get that return, but hopefully on a portfolio basis, when we have 20 to 25 managers, they will be able to get that return on average. So that's the way how we think about you start the question with finding the next Sequoia. I don't think that's the wrong way to think about it, but I think there's so much nuances in terms of how we're constructing the portfolio and what kind of managers that we're trying to put in our portfolio.
And like Ethan mentioned, returns and liquidity are the two biggest factors we're thinking about at any given time. I think another part of our portfolio that Ethan and I both really value is the fact that we don't have buckets. We're purely thinking on a returns first perspective, of course, taking into account risk. But I think a lot of our peer set has to allocate to certain buckets. And thus the benchmarks are for private credit specifically or for buyouts specifically. But we're looking across sort of all private asset classes as a whole and thinking about the best use of capital, but also taking into consideration distributions across that.
I want to build on or double click on a few things you all said that's so fascinating. One is the importance of liquidity. And I was just reading the other day how Stanford has been so reliant on the government. And even despite how massive its endowment is, they're like pausing hiring. And so liquidity, I would have never thought that Stanford would have to like deal with those issues. But clearly, even if you have a big endowment, you have to always be thinking about liquidity. The other thing is liquidity for VCs. So many other VCs have told me, hey, you should make sure you have liquidity between the funds. You can't just be like, go, then fundraise. You need to be thoughtful about that. And you need to ensure you have liquidity for your best follow-on. So the liquidity is something that everyone focuses on. The other thing that I found fascinating is you all are very returns-based. And because of that, that has enabled you to be visionary in terms of emerging managers. And so it's that whole balance between transaction and vision and doing that. And related to that is so many times I've heard Oliver Wolf-Botha's podcast, and he talks about crucible moments and all that, but he also talks about how mission driven they are. And they talk about, we invest on behalf of pensions, endowments, ENFs. And similarly, they find founders that are mission driven. So now I'm starting to see this whole mission driven from the LPs to the GPs to the founders. Last note is that it is so interesting to see Vanderbilt, in my perception, being one of the more active, like networked, progressive, like going to events team. And usually it's just one person, not two people. And I'm curious about how you all are engaging with the community, building the community, and what do you think is the future for limited partners, especially ones focused on venture?
Mm-hmm. Well, first off, I have to thank Anders Hall, our CIO, and Roy Yum, our head of privates. I think they both have a vision for how they want to build team and culture, and it really is top down and bottoms up. They themselves as leaders to be driving culture, but also want the analysts at the bottom to also be bringing their perspectives and diversity of thought to the table as soon as they enter into our organization. And I think that's really critical. Ultimately, they've given us a lot of autonomy to approach the space how we think the space should be approached. whether it be, building a nonprofit organization on the side that really benefits Vanderbilt. I can touch upon that, but traveling, surfacing conferences globally that we think could be additive to the program. So I think it really is just a sign of the culture that we have internally. The Emerging Allocators Association is something that myself and one of our other colleagues, Luke Blanton, actually established about a year and a half ago. And it was a result of this idea that next generation talent across the allocator space is going to become more and more important. And growing connectivity across it has a lot of value. Obviously, people our age, we're young in our careers and we have a lot to learn, but I think we also have a lot to add. And our perspectives are going to be those that shape the industry for the next couple of decades. And so Ethan and myself oftentimes are the ones pushing opportunities into the pipeline and meeting with the GPs and then bringing them to the table for the rest of the team and Roy and Anders to give their opinions on. We felt like we could more digitally start to share opinions on a Slack channel across the space instead of waiting to hop on a Zoom call or see them at an AGM. So we started scaling it off of a Slack channel. We have about 300 members now across 150 institutions. It's been a lot of work to drive engagement digitally when people haven't met face to face. So we started an event series, and those events manifest in a couple of different ways. Sometimes it's portfolio company tours where we actually give LPs the ability to see what founders are doing on the ground. I feel like that's something historically that LPs have not really been able to take advantage of. And I think being able to actually see what's being built inside of the funds that you're investing in gives you a greater appreciation for the GPs at the table. And also founders get a sense for what the LP world is about, how LPs could be additive or how they could be potentially useful in building the allocators' knowledge on different ecosystems and sectors and trends. So sometimes it's those sort of tours. Other times it's just more happy hour or networking type events where we could talk about deal flow. So at first it was really just about building connectivity, but I think over time it's scaled into something that's become really helpful for Vanderbilt and also our GPs. We've mentioned, invest in a lot of emerging managers, and we want to de-risk their fundraise. We want to be additive from the second we invest. And so as a result of EAA, we've been able to make some really integral connections and introductions for the GPs that we're investing in after we come to the table. We know the 5 to 10 other endowments or foundations or fund of funds that are actually investing in a certain sector or size of fund or type of asset class and can make those connections lifetime happen super easily. So that's been one way we've been going about it. Ethan and others on the team have been doing a lot of work too. So you should chat about that.
No, absolutely. That's incredibly powerful. And I echo with everything Grace has mentioned. Obviously, incredibly grateful for Anders Hall and Roy Young from the leadership that allow us to have the freedom to explore a lot of things that no one really from the LP community that has explored before in the emerging manager space, especially for E&F. I think there's a lot of fund of funds that are very progressive in thinking and are pioneering a lot of the efforts. I respect a lot of them. I think, all the points that Grace has mentioned, it's not only about building a presence, it's also about building a reputation and be truly helpful and value add. Because we're reflecting ourselves on the questions that we're asking our GPs. Mm-hmm. The right to win a deal, why the founder wants you. We're asking ourselves why the GP wants us as well. And I think, obviously, we're winning a lot of deals because we are a reputable endowment. But I think other than that, we need to create something even more beyond that. And that's everything that Grace has mentioned. That's EAA, that's facilitating a lot of those intro calls for our managers. I've been joking this more than one time with more than one of our managers saying that you should pay us as a placement agent. Obviously, that's a huge joke, but that's also a reflection of how many intros that we're trying to facilitate. It's also about understanding what our peers want, because it's not about purely connecting people with other people. It's understanding what both the supplies and the demand side want and matches those demand. And I think that knowledge, that know-how can only be built by really establishing those genuine relationships over time and getting to know each other from both sides of the table. And I think a third thing that I wanted to mention is really what's underpinning this is important to. It's very noteworthy. I think I wanted to share a little bit here is we're not just trying to go out as a 25-year-old and 27-year-old and trying to find interesting idea out there. I'm incredibly grateful for Roy, our head of privates, in his thinking and wanted to back what we're doing with data and quantitative thinking. So our analysts actually have been doing a lot of work on the historical data of the venture ecosystem, and also not only on a fund basis, but also within on a company by company basis, and trying to understand what are the stages, what are the formats or shapes that we should expose ourselves to, and how we can construct a portfolio with the kind of liquidity we want, with the kind of volatility we want, and with the kind of return that we wanted. And I think that is really the backbone that enable us to be confidently going out to host those events and to do those outreach and really helping as much as we can within the community.
I'm just going to quickly summarize or try to attempt to back brief it and then launch into a set of questions around emerging manager landscape now. The first is, what I find fascinating is that oftentimes there's a joke with like founders and investors that there's an age disparity. And there's also something that's not said as much, but with VCs and LPs, there's typically, I feel like I'm talking to someone 10, 20, 30 years older than me. And that is definitely not the case with Vanderbilt. And so that's really interesting. And I think there's probably advantages of like understanding trends or technology changes that you all are going to pick up. And then you're going to be able to identify the GPs who pick up those trends too. The question I have is around how you all approach emerging manager in a very, I guess, numbers based, right? Like, so of the endowment, which is now 10.4 billion, how much do you all, and you said like we don't necessarily put it in buckets, but like what's the right number? How many are you trying to invest in? What's the fund size that you like? Hint, hint, I've heard it's like 75 million or lower. What's like portfolio construction? So all the nitty gritty stuff that most GPs, at least Fund 1 GPs, will be shy to ask, but Fund 2, Fund 3 will ask directly.
I think there's a lot of different definitions for emerging managers going around. And so for us, we've really tried to internally define what that means to us. Historically, if you look back even pre-Anders Hall, we've always been investing in emerging managers across asset classes. He instilled that even further when he came over from Duke in 2013. And if you look at Sequoia, we were a Fund 2 investor. If you look at Founders Fund and Thrive, we were also very early there, which are now obviously brand name, multi-stage, large players in the ecosystem. But ultimately, what we're trying to do is be a partner at the beginning of a life cycle of a fund where GPs are hungry and there's a reason that they want to win. And that manifests across all asset classes. Venture just happens to be the one that we spend our most time on, Ethan and myself, so we talk about it the most. In that space specifically, we define emerging manager as usually Fund 1 through Fund 3, sub 100 million in size. And because we're focused on pre-seed seed, there's certain types of portfolio construction that we like to see. Oftentimes, the GP is an ex-operator turned investor. Of course, we do back the career-long investors as well that are spinning out from brand name shops. But I think there is something to be said about this whole ecosystem of people who have been spending their careers in the trenches building, who actually understand what founders are going through on a day-to-day basis. And we like the non-traditional backgrounds. If you look at our team, we all have pretty non-traditional backgrounds. And I think there's value and power to that, especially because a lot of founders themselves also have those histories as well. I'll stop there, Ethan. There's a lot to cover there, but happy to chime in after.
No, absolutely. I think a key theme that I wanted to put on top is we don't want it to be dogmatic. I think, sometimes I share with some of our managers that the sweet spot is 25 to 75. I use that as my mental heuristic, of course, but I think there's always exception to be made. And I think one thing that our CIO has said really well is never say never, and also be open-minded. We can't be like, hey, we never invest in Series A firms. That's why we don't look like any funds that touches Series A or above $150 million. I think that's the wrong mentality. And that's not only the wrong mentality to invest, but also that's the wrong mentality to build network. Right. So I think, so that's the first thing that I wanted to get it right at the beginning. I think one thing that Grace didn't mention or didn't spend as much time on talking about is the differentiation part of it. And I think this goes back to our discussion on having the right to win for the GPs, obviously. I think you have to have a very specific value proposition, especially for emerging managers, to really set yourself apart from a trillion other, well, I exaggerated, but thousands of other emerging managers. We literally spoke with 300 to 400 new emerging managers every year. Some of them even failed to launch, or some of them decided to join force with other people. But there are just so many of them. And what you think inside a room, brainstorming, you think that might be your edge. It's not actually an edge for in the grand scheme of everything, of everybody in this ecosystem. So that's why if you look at our portfolio, a lot of our managers has been capturing very specific ecosystem, a specific sector, and have very deep knowledge to understand what the founders are building and what kind of knowledge or value add is required to operate in the space or in the ecosystem. And obviously, I don't want it to limit ourselves within the, like, we only invest in specialists. That's not true. That's also true to some extent that that's not the way how we're defining a specialist. Our definition for specialist or differentiation is very broad. It can be in the sense of the traditional sense, which is sector, which is knowledge-based, but also if you have a specific unlock to a coveted ecosystem, that's good enough. So I think that's one thing that I wanted to stress out there as well.
Two observations from what you all said. One is that oftentimes, not oftentimes, all the time for VCs, we're evaluating teams and we're looking at how teams interact with each other. What I find really interesting, and you can quickly thin slice and be like, oh, like there's founder tension, or they don't know each other very well. And that was like the first year or first few years of venture investing. Now I do that with LPs. Now I'm like, oh, I should also do my assessment on the LPs. Yep. And what I find fascinating, this very short conversation, is you all keep mentioning Anders, I think Royce, your teammates, and like how you all talk with each other. And like you can tell venture firms and LPs by like that team dynamic. The second thing that you all said that's fascinating is it feels like there's a ton of like positive tension on this barbell thing around, you got privates and publics, where like you liquidity from your publics and then your privates are like, hey, like these are our Hail Marys. Yep. And it feels like you also have this barbell tension within venture because you all are in Sequoia. I've heard rumor is that you're in Altos. And so you're in some like real tier one firms and then you're taking some chances on some other emerging funds. Mm-hmm. Can you talk more? Is that deliberate? And like what other aspects of your strategy do you all like deliberately think or create and craft?
Mm-hmm. Well, we're going through a little bit of a venture portfolio rebuild right now. Post 2021, like Ethan mentioned, we had a 57% return year, had a lot of growth bubble up in the portfolio. We'd been allocating to what some would call like value arbitrage plays, where we were investing in funds that were focused on that pre-IPO deal, and then we capture the quick growth afterwards. And ultimately, moving into 2022, we had a lot of learnings on some of those strategies and decided to pull back from the venture growth arena and then do the quantitative deep dive that Ethan actually led on our team, really assessing where the best use of capital was in the venture ecosystem. We still want to back the groups that have been the return drivers for decades, like the Sequoias, but we also want to take risk on the GPs that could potentially, one, become the next gen brand name platform, or also have the potential to be the 5-10Xs, where a fund that's managing billions and billions of dollars is way less likely. So that's ultimately how we came to the thesis of building out this sub-portfolio of new Fund 1s and Fund 2s, sort of reinvigorating the portfolio with smaller fund sizes, a little bit more hustle, less of a machine at the table. And Ethan can talk a little bit more about the quantitative element of how we got to that 20 to 25 names.
Yeah, absolutely. And we've been sharing this with a few groups on the quantitative work that we've been doing. And obviously, that's a whole team effort. Our analyst has been doing incredibly great work on this. But as I said previously, that we wanted to stay true to the return that we're seeing across different stages. Obviously, the preliminary conclusion that we're getting is at pre-seed seed stage is where we can find the highest expected return after adjusting for dilution and adjusting for survival rate. Obviously, they see much higher dilution and much higher survival rate. But after we take them out from the data set and compare everything across across different stages, apple by apple, they're still winning the game, not only on a MOIC basis, but also on an IRR basis. And the next step is really constructing the portfolio about 20 to 25 names. It's hard to really explain without having a presentation deck, but I'll try my best. We use a very simple statistical tool called Monte Carlo simulation, where if you took high school statistical class, there's a theorem called central limit theorem, where if your sample size is enough and you draw from a population for enough times, you'll get a normal distribution on the return. So we're experimenting how many at a company level, how many companies that we wanted to have exposure to, because ultimately, as you are investing at early stage at pre-CC, there are going to be so many zeros, but also might be 5x, might be 100x, might be 1000x, and it's about optimizing the number of companies that you wanted to have in your portfolio. And Monte Carlo simulation basically tells you as the sample size grows, the distribution will approach to become more and more normal. So we started to slightly tweak up that sample size from 20 to 50 to 100 to 200 to 400 to 600. And we started to figure out that as we turn up that sample size, the return that we're getting in terms of from diminishing the volatility is getting lower and lower. Because at the end of the day, you're approaching a normal distribution, but how normal of that distribution is good enough? It's the question that we have to answer ourselves. So ultimately, we chose 400 to 600 names as a range. We don't want it to be dogmatic about either it's 400 or 600. Ultimately, is a game more art than science, but we wanted to back with a very quantitative mindset before making the decision. So what we're having here today is we're trying to build a 400 to 600 names portfolio across deployment period in venture, which is going to be around 2 to 3 years. And the philosophy of us is really investing managers that have a certain level of concentration, but also, I understand, Tim, when you're running Context, you can't have like a 5-name portfolio because this is too much business risk for you to take. So like the level of concentration as much as our manager is comfortable with. And that number that we see repeatedly again and again from many of our encounter with managers is around 15 to 30 names. So doing the math, divided 400 or 500 by 15 or 30, you get to that range about 20 to 25 names is where we initially got the range of managers that we wanted to have exposure to.
One of the things we love to hear GPs say is that it's the LP's job to diversify and that they can take high risk and be highly concentrated. So that's kind of how we think about it.
So fascinating, because yesterday I was talking with Jamie of Screen Door, and she was previously at Virtus, and they were the first institutional LP I met for Fund 1. And I had no idea what I was doing, but they were kind enough to meet me. And my main takeaways from that meeting were they like when pre-seed funds do 50 or more investments. They said, we really like investments that are heavily in like the tech hubs, and we like little to no reserves. And it's just interesting to see how different LPs have a different statistical or quantifiable like a viewpoint on what is optimal portfolio construction.
The little to no reserves comment's interesting, though. I think it sort of combats the 50 names because ultimately what we're thinking about is a blended entry cost valuation. And so When you're only putting initial checks across 50 companies, it makes sense to diversify. But if you are reserving 30 to 40% of the portfolio to follow on at a higher cost basis, that's a little bit less compelling to us because we're focused on getting pre-seed seed exposure at, sub $20 to $25 million valuations in most cases.
Yeah, and one thing that I really resonate with you, Tim, is you mentioned the tension. There's a lot of tension within our team. Obviously, very healthy tension within our team and across the public team and private team. And the reason of that tension is we wanted to stay true to the return, stay true to the IRR that we can generate. If you feel like there is a manager that can generate 15% IRR on the public side consistently, then why you are investing in a lot of managers, I won't name the name, but those managers on the private side that will never beat that number. And another piece that I do wanted to stress, and I don't wanted to stress that in a very cautious way, is co-investments. There's so much discussion on that. There's adverse selection. There's nepotism of the GP, which LP to give co-investments, and it's always a pull and push. But we do wanted to mention here that co-investment is actually a very important part of our portfolio as well, and that is not only for us to generate higher return on the slightly lower fees, but also really build upon the knowledge base that we built by investing in those early stage managers, obviously buyouts as well. But I think the gist of our intention is we can build those relationship with early stage managers being one of their first institutional checks and help them really focus on what they're really good at. And when their companies are graduating from pre-seed C to Series A to Series B, we wanted to be able to help them from a capital perspective, help us as well, obviously from a return perspective. We're trying to be relatively more systematic and capturing the highest signal companies rather than re-underwriting the specific companies. Because if we're doing a better job underwriting the specific companies while we're hiring those managers. So the goal is, so as we mentioned, we're barbelling the portfolio a little bit. On one side of the spectrum is pre-seed manager. On the other side of the spectrum is, not venture, but like real growth equity managers and buyout managers. But in between, we're bridging that with a lot of co-investments that we're trying to put in our portfolio. And we are sure that as those companies graduate from pre-seed, they will become a Series A company, become a Series B company, become a Series C company. And in a steady state, we should have a portfolio that has company that at every stage. But obviously, that is kind of more of a theoretical thing in our mind, and that is always beautiful in theory but harder to achieve in reality. So we'll see in the next 5 to 10 years.
A couple more comments to make here, both tying back to your question you asked about building relationships and community, but also to what you just said, Ethan, about a lot of thoughts from both LPs and GPs on co-investments. A lot of the times LPs move super slowly and say they want co-investments, but then can't pull the trigger or make a decision within a week. And for us, we really want to hold ourselves to the same standard that we hold our GPs to when you're working with the founder. We want to be able to move quickly and make a decision and be value additive. So one of the things we've been working a lot on internally is how are we not just a capital provider? How can we be more than that? And use and leverage the Vanderbilt ecosystem as a way to bring resources, both financially, but also commercially, to the table for founders. And so a lot of the times when we're investing direct on the cap table or through SPVs, we're trying to be helpful to those management teams, whether it be in healthcare, getting them connected to the Vanderbilt Medical Center. We have pretty direct lines of contact now to the innovation heads there who can kind of direct us on what new technologies they're looking to bring into the ecosystem. We're also now building relationships with different community heads within the Vanderbilt University itself. So like the department that focuses on waste management and construction, there's a lot of supply chain tech and construction tech that we could tie in there. The AI department, we can obviously have sort of researchers and engineers be helpful as well. So just trying to be more than capital, and that could hopefully also help with the adverse selection piece of what we oftentimes hear.
So much to build on that, but two quick observations. One is there's a ton of veterans at Vanderbilt, and a lot of them benefit from the financial aid that your endowment spits off. So thank you all. The second is the whole like connecting everything. My understanding and word on the street is that there's a pretty big conference coming up in Vanderbilt.
Yep.
And like Sam Altman's going to be there,
We're
some
excited.
other really big names. And I got to believe it's because an investor and investing in Sam Altman or something like that. Can you talk more about that event coming up?
That's a great question. So the Institute for National Security on campus recently launched. Been something that our office is actually really passionate about. We've been spending a lot of time digging into the hard tech space and defense specifically, and feel like, building off of what I just mentioned about being value additive to campus and vice versa, we can really leverage our portfolio to give students and faculty the opportunity to get more tied in to technology and to what's actually happening on the ground in the venture ecosystem. I think historically, Vanderbilt has been a little bit behind when it comes to really driving entrepreneurship on grounds. I think over the next 5 to 10 years, especially with the current chancellor we have, that's going to change. And I think the Institute for National Security is a really big piece of that. Sam Altman is coming to speak because the man who leads the Institute right now, General Nakasone, was actually recently added to OpenAI's board. And so there's a lot of connectivity that I think we'll have to Silicon Valley as a result of that. Sam Altman's brother, Max, has become a recent friend, and I respect him and his perspectives a lot. And he also obviously wants to become more tied to sort of what's happening on Vanderbilt's campus as well. But I think that's a little bit of kind of the history of the Institute and why Sam's coming, but also how we're trying to be a little bit less siloed from the campus, try to leverage what we have and bring it to the table a bit more.
I almost hesitate to ask this question, and it's only a Tim question. It's not even something that most people in the audience would want, but I like to study history and context and how things are connected. So Swenson obviously was the guy who really started venture investing, and he started at Yale. My understanding is he had a bunch of acolytes, and one of them went to Princeton. Did Royce and Anders, who were at Duke, were they kind of connected to that whole Swenson lineage?
That's an interesting question. I know that Roy went to Georgia Tech and then worked at an asset management shop for a little bit before coming over to Vanderbilt. I actually don't know Anders' full history. You might know more than I do, Ethan.
So I think that connection with David Swenson back in the days was with our prior CEO, actually 2 CIO ago, a gentleman whose name is Bill Spitz, who's still in Nashville and very active in the investment management space, who really helped the endowment to get into some very top tier brand names in our portfolio. But obviously, I think it's a very interesting historical exploration for us to learn what happened in 1979, what made our decision to get into the
And
Sequoia.
it's all files, paper files and cabinets somewhere in our office.
There is a cabinet room in our office with a bunch of paper.
Yeah.
Maybe one day Grace and I are going to dig into that room.
We were just talking about this the other day of wanting to go through and read diligence notes from back in the day. So we'll have to do it at some point.
And that actually now connects me to the original question that I should have asked. But on that, there's in starts in Silicon Valley history, it starts kind of with the traders, a Fairchild. And so I bet for LP World, you can start with Swenson and like show all his disciples and acolytes and like how they've kind of like built on top of what he's done or changed a bit. And I bet what you all are doing at Vanderbilt is in my opinion, like a key part of what LP and venture is going to be looking like. And so within that cabinet of like goodies and knowledge and insights till now, what have you all learned about firms like Sequoia and Altos who have really hit it out of the ballpark? Like, what have they done that you're hoping the new funds you're investing in will do? Obviously drive incredible returns, but what other like tactics, techniques have they practiced?
Yeah.
Or,
I think one of the most important things we underwrite is succession planning and thinking through how teams will hand over the reins when one generation ends. And I think we've seen that happen with Sequoia. We've seen it with other funds in our portfolio who have either done a great job of it or maybe not so much. So I think that's one of the biggest things that I've learned is how much we need to underwrite the people at the helm of these organizations and how their theses and beliefs on the world are going to translate to the principals and partners that they're bringing on, over subsequent funds.
Yeah, I think one very important part of that is culture. Obviously, not only Sequoia, but also funds like Altos. If you look into the culture of those firms, those are just incredible with leaders on top of the firm that were able to really pass down the culture to the next generation, Obviously, my knowledge about Sequoia, a lot of those are coming from book like The Power Law and a lot of text that we can find online and really speculating and guessing and trying to learn what happened there. But I think like Altos is a great example, right? Altos, Han, Anthony, they are really great culture builder on top of the firm. And I think that's something that we're trying to do ourselves as well, because ultimately what the people that you're attracting are people who enjoy the culture, who want to become part of the culture. If you don't have a culture, then if you don't have a good culture, then the people who are good, who have a good culture will ultimately be turned away. So I think that's something that we always constantly think about. And constantly trying to do a lot of innovation. We started to do more and more offsites to discuss those topics as well within our office, actually. And I think another piece other than culture is really discipline. I think if you look at all those firms, they are disciplined and patient.
The bar doesn't change when the people go in and out. The same standard is held.
Exactly. Yeah. It took Altos for many, many years to see the returns started to come. And also, I think the failure of a lot of firms that we see out there is as they started to get momentum, as they started to get traction, they will grow the firm as big as they can. And only realize after a market downturn that this is the wrong thing to do, but oftentimes is a little too late. And I think this is also the reason why I wanted to stay with early stage ventures, right? Going back to the original question, that there's a certain fund size that you have to operate with if you wanted to invest in seed, if you wanted to invest in Series A. With a lot of dry powder in the portfolio, I think maybe you can generate from an dollar value add perspective by employing more money. Obviously, that's what a lot of sovereign wealth fund wants because they have a much higher capital base. But for individual LPs and for institutional LPs that are at a relatively more nimble size as Vanderbilt and as a lot of endowments and foundation, we wanted to have exposure to the high octane, disciplined, patient GP who are very thoughtful about what they want to invest, what kind of fund size that allow them to invest what they're good at.
I'm going to quickly synthesize or build on four things that you all said. First is the tension exists between the qualitative and the quantitative. You all clearly want the returns, but you all are clearly saying it's the qualitative aspects, the culture that drives the returns, which is interesting. The second thing is the long-term viewpoints, you all having a long-term viewpoints, the investors, the GPs having a long-term viewpoints, and then the GPs always want founders to have incredibly long viewpoints. So clearly everyone wants to be very long-term oriented. And then the third is the fund size that you all have. It's so interesting that at 10.4 billion, you all are still doing emerging managers, because when I meet 10.4 billion ENFs, they're like, we write $150 million check sizes and that's it. And like, once you get there, maybe come meet with me. Until then, like, figure it out. And that gets me to, unfortunately, our rapid fire questions, just because we're running out of time.
Of course.
I do want to acknowledge that Grace and Ethan have been on the road for quite some time. I am truly grateful that they're coming in to do this in person. And Ethan and Grace are just super thoughtful and generous with their time. And so I want to be that with your time. Hopefully, maybe we can do another episode a few months to quarters out. But some rapid fire questions, because I don't think the audience really knows who you are, or like a little like your personal things, and it's been purely professional. First is favorite movies. Feel free to name more than one.
Troy, Braveheart, Dreamer, and Miracle. Those are my top 4.
I'll name 2 that shows the 2 sides of my personality. One is Full Metal Jacket by Kubrick, and the other is Up in the Air by George Clooney.
Very interesting film selections. We don't have time to discuss them.
We'll delve in at another point.
Favorite travel spots, whether it's work or for fun.
My goal that I set for myself was to do a solo trip every year. And last year I did the Isle of Skye and the Lofoten Islands in Norway. And those by far have been 2 of my favorite places I've been.
For work, I'll say Tokyo. For fun, I'll say Mallorca, Spain.
Nice. Those are some high-class spots. What is a major personal goal you have for the next 12 months?
Professionally, to continue driving the EAA effort forward. I think there's a lot of value that could be captured through that. Personally, to celebrate my mom's 60th in a really special way.
Similar to me, I wanted to, first of all, celebrate every moment with my family, my friends. Professionally, I just wanted to keep doing what I'm doing. I think one thing, sorry to elaborate this a little longer, but the reason why I'm doing this is because the learning curve of what we're doing is super steep. And I think I'm just going to keep doing this as long as the learning curve is still that steep. Meeting new people, learning new interesting insights and ideas, and hopefully make a few more investments that will be long-lasting for the benefits of the endowment and for the benefits of hopefully humanity.
Very last rapid fire question. Favorite Vanderbilt sports team or favorite Vanderbilt sports event that you all got to celebrate
I
recently?
have to say football after the last year. Come on, carrying the goalpost down to the river in Nashville. Pretty cool.
For me, I have to comment on that because when I was a student, I remember the football game where Vanderbilt lost 54 or 57-0, and it was obviously a long-lasting traumatic experience to me. But I'm very happy that the sports team is doing really well. I have to say baseball because I was watching the game and Ethan Paul on our team.
Yes.
Thank you. All right. So if you're a emerging manager and you want to meet Ethan and Grace, I recommend go to any LPGP event. There's a good possibility you're going to meet them there. They're super active in this community. They are truly advancing venture capital. Grace, Ethan, thank you all so very much, especially given all the travels you have been doing.
Thanks, Tim.
Thanks.